So gold was obviously lifted up as well yesterday, but not a huge move in gold. No, it wasn't quite as excited as silver was from that move. But we did bounce off a support level at around 180 on GLD here. We are still a ways off the highs. But basically, over the last couple of weeks, the geopolitical premium that was in gold has been taken out. And that's this kind of move back down here that we saw. Now, we've bounced because we saw real yields move swiftly lower by about 20 basis points, and the dollar got whacked as well by almost two big figures. So from 106 to 104. So these tend to be supportive things for gold. So it makes sense that gold should have had a bounce yesterday. But we just think in general, gold has shown a lot of resilience this year. Okay. And given the face of quite a strong dollar, real yields got as high as 2.5%. The fact that gold really held in there pretty well, even before the geopolitical pop that gold had, it was holding in there. It wasn't collapsing the way you might have thought it would do in the face of those conditions. So we do think ultimately gold is headed higher. These highs at like 2080 in spot, which is about 195 in GOD, we think these highs will get taken out at some point, especially now that the cycle in rates seems to be turning. It does look like the Fed's going to go a bit more easy now. They've got the cover to do that with looking at what's going on with inflation. So if and when we do break, and we think it probably does happen, maybe in the first quarter next year, then we think there could be a big acceleration higher in gold once those all-time highs break. So given that those have failed on multiple occasions, when they do finally break, that in itself will be a catalyst for quite a swift move, where we could go from 195 to kind of 215 pretty quickly, right? Which would be a quick 10% rally. Maybe it does even more than that. But I would have thought the first 10% would happen quite fast. So in preparation for that move, I want to find ways to own that upside tail, because I think, when it comes, it could be quite a volatile event. Okay. So looking at our dashboard, well, what stands out here, obviously, vol has come down. The front end has come down a lot because that was inverted, but even the back end has come down considerably. So the curve is quite flat in gold. So owning this longer dated part of the curve isn't expensive because you don't have a really steep contango. You look at the call skew is flattened. We've got the 90-day one, which is the yellow one, that got 3 to 4 vols for calls. That has flattened back down to sub 2. So that is good to see that war premium coming out of the upside. So in general, we think longer dated upside doesn't look like a bad thing to get on board now that vols have retraced, right? See, vols spiked up here. They've come back down to more reasonable levels. So how would we structure this trade? We don't necessarily want to pile into a load of delta right now. Gold is kind of in no man's land. It could rally back towards the highs, but it could easily go down in the near term. So we don't need a load of delta. What we want is we want volatility exposure if this thing does break the high.